The crash of 1929 wiped out 86% of investor wealth. In 2008, over $8 trillion was erased. The dot-com bubble incinerated $5 trillion more. Yet in every instance, the most perceptive investors weren't caught off guard. They recognized the subtle warnings, repositioned early, and emerged wealthier while others tallied their losses. These elite players didn't rely on luck. They noticed the signs long before the alarms blared, signs that the market whispers quietly before it screams. And now, once again, those whispers have begun. It starts with a feeling, euphoria, a phase where ordinary people behave as if prices only move in one direction, up. In the roaring 20s, unseen homes were bought on loans no one could afford. In 2007, waiters proudly flipped multiple condos without proof of income. Not long ago, barbers shared screenshots of meme stock windfalls or NFTs worth more than their cars. Euphoria peaks when social feeds overflow with overnight millionaires, when dinner conversations revolve around the same hot investment, and when not joining the party feels foolish. That sensation, exhilarating but dangerous, is the moment smart money starts selling, not buying. These frenzies provide the perfect exit for the wealthy, who unload inflated positions onto eager dreamers. When euphoria takes hold, wise investors quietly trim bloated holdings, ensuring they're not the last to exit the dance. Then comes the distortion of valuation, when stock prices drift so far from logic that even basic math can't justify them. In the late 90s, a pet food website with no profit was valued higher than Delta Airlines. In 2021, electric truck startups with no product were priced beyond Ford. Today, some stocks still trade at levels that assume tenfold revenue growth without a stumble. When a company earns just $1 for every $600 in stock price, investors are paying centuries ahead. That's not investing. It's a wager that someone even more exuberant will take it off their hands. When entire sectors float on such valuations, history warns a reckoning is near. The solution isn't to sell everything, but to anchor core investments in businesses with real dependable cash flow, ones that fall less and recover faster when the tide recedes. Next, the easy money dries up. Every bubble is built on cheap cash, and every collapse begins when that cash disappears. Before 1929, interest rates doubled. Before the dot-com bust and the 2008 crisis, credit tightened sharply. Rising rates make mortgages, car loans, and business debt more expensive. Suddenly, the economy feels heavier. Consumers scale back, companies struggle to refinance, and cash becomes king. Think of liquidity as water in a tub. The Fed controls the faucet, daily expenses pull at the drain. When the faucet slows, the water drops, and hidden problems are revealed. Investors can spot this shift by watching the M2 money supply. When it flattens or falls and central banks talk of holding rates higher for longer, the setup is in motion. That's the time to reduce debt, lock in fixed rates, and keep dry powder ready for what comes next. As money tightens, cracks appear. Weak links in the system begin to snap. Hedge funds overloaded with leverage, real estate developers drowning in floating rate loans, exotic financial instruments no one bothered to monitor. In 2008, it was subprime mortgages. In 2020, corporate debt. The next domino is always different, but the symptoms are familiar. Junk bond yields spike, treasury auctions fail, and trusted funds start freezing withdrawals. These are not coincidences. They're early tremors. The most alert investors respond by lowering leverage, refusing new risk, and shifting into safe, uncorrelated assets like gold, cash, or short-term treasuries. Then volatility awakens. Markets don't crash from calm, they thrash first. Wild swings become routine. One day stocks surge, the next they plunge. Then fresh highs fade by noon. Before Black Monday in 1987, and again in late 2019, the VIX crept upward for weeks, quietly signaling that calm was fraying. A rising VIX while prices remain high is a telltale sign. Investors exposed to high-risk positions, like naked options or leveraged ETFs, should start scaling back. Small protective moves like buying puts far below the current market cost little before panic spreads but deliver immense relief when it does. When these whispers overlap, Euphoria, absurd valuations, drying liquidity, credit strain, and rising volatility. The spark could come from anywhere. A political upheaval, a corporate scandal, even a natural disaster. The trigger doesn't matter. What matters is the readiness. Markets don't fall because of one event. They fall because the stage has been set. The strategy isn't about panic, it's about preparation. Layers, not leaps. Keep a foundation in broad index funds, but trim sectors that have grown too dominant. If tech has ballooned to half your portfolio, cut it back to a third. Rotate into areas others have ignored: healthcare, utilities, or short-term bonds. Maintain a cash buffer, enough for 6 months of expenses, plus a little more marked for opportunity. During bull markets, cash feels useless. In a crash, it's power. A disciplined hedge, a few long-dated puts on the market, is like home insurance. You don't want to use it, but if chaos comes, you're covered. Only a small portion of the portfolio is needed. The goal isn't to profit from doom, it's to cushion the fall. Every position should face a test. If it dropped 30% tomorrow, would it be worth adding? Or would it trigger panic? If the answer is panic, exit now. Above all, automate contributions. Crashes terrify the heart but reward the calculator. Dollar cost averaging during downturns builds wealth silently. History's great investors, Buffett, Templeton, Lynch, made their biggest moves when fear ruled the market. Paper losses are inevitable, but optionality and survival are what define long-term success. In every crash, wealth moves, from the impatient to the prepared. There's no need to predict the day, only to recognize the setup. Right now, early signs are flashing. Euphoria is bubbling in AI stocks and crypto. Some valuations suggest flawless growth for centuries. Interest rates are still high. Credit markets have started to flicker. Volatility twitches beneath the surface while markets hover near all-time highs. It might fade, or it might ignite. Either way, the checklist is here. The smart money is already preparing, and the clock is ticking. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.